Today's market call is presented by FactSet, financial data and analytics powered by tomorrow. 1 o'clock on the East Coast. Guy Adami, Dan Nathan, soon to be joined by the great Carter Worth on what is a very rainy Monday on the East Coast. Record amount of rain. Dan, how are you?
You know, it's crazy, Guy. I walked out of my home in Manhattan this morning, and it was raining in the morning. But when I was walking out, it was kind of like 8:30 or so. The sun was coming out. It was 60 degrees. It felt like a glorious December day. And it's glorious for so many reasons on deck 18. I'm just going to do this, Guy. Last week, it was December 13th, and we wished a very special happy birthday to Taylor Swift. She turned 34 years old. And I know you're a huge T-Swizzle fan. You helped name her back in the day. You were G-Swizzle, and you said, you know what, this Tay-Tay, I don't know if that's going to stick, but T-Swizzle should stick. And it has stuck. But it's your birthday today, and I wish you a very, very happy birthday. So people blow them up. Get in the comments section. Let's get them trending, because I'll tell you this. I was on the Twitter this morning. I don't go too frequently, guys. I just like to see what was trending. Brad Pitt was trending. Keith Richards were trending. They both have birthdays today. Why isn't Guy Adami trending? Guys, gals, let's get him trending. Happy birthday, Guy Adami.
I appreciate that. I'm a fly in their asshole, but very much appreciated. And I'm wearing my this is the tie that says "Age to Perfection."
Nice.
Which there you go.
That is the biggest knot I have ever seen you.
You know why that is? I'll tell you why that is. Because
Why?
I had the tie is so long, and in order to see this part, I had to do it. Anyway,
that's
so
amazing.
there you go.
All right, so what are we doing today on the market call?
Now.
What
let's take a look at the rundown. We'll go through it now because everybody's bulled up for 2024. That's for sure. And you know what? Maybe it's correct to be. Do we fade in the home builders here? We talked about that with Elizabeth earlier today on our podcast that has dropped or will drop in a few minutes. And we got big earnings this week, big in the form of Nike, FedEx, and Micron. FedEx has had a little bit of a run here, so we'll see if it continues. But that's it. And again, as I mentioned, the great Carter Worth will be joining us.
Well, it's interesting. So we talk about the home builders, and you and I detailed a bearish trade idea into Toll Brothers a couple weeks ago, and that just got absolutely blown out. And again, it was using options. It was a put spread, defining my risk, and we were using a premium stop on that. But that thing rallied 15%. I mean, in a straight line to a new all-time high. So Carter's got much better timing than us. So he's going to go through the charts and he's going to walk us through it. But I have another trade, people. I am nothing if not persistent, right, Guy? All right, let's talk about some of these. Listen, it's that time of year. We've been talking about it on the tape, on Market Call, on Fast Money. All these strategists, they put out their outlook notes for 2024. They put out these S&P targets. They try to figure out where S&P earnings are likely to be relative to consensus. They do a little math. They come up with all that stuff. It seems like since the Fed meeting, though, Guy, right, and we've had this basically explosion and this dramatic drop in rates, I mean, a lot of these folks are actually now questioning some of the outlooks or some of the targets that they put in place just a few weeks ago before this big rate move.
Yeah, it's pretty interesting. And Danny Moses talks about this, and Carter, and I'm sure he will mention it. But in our world, if you're behind the 8 ball being bearish, it's a very difficult place to be. So I think a lot of these folks don't want to get caught in the same sort of, conundrum they were in for 2023. Some of them, at least. I know I've found myself in that camp. Now, I'm not going to switch horses at this point because I still think there's tremendous headwinds that for whatever reason the market's looking past. But a lot of people saying, career risk, we don't want to take it. Let's just get on the right side of history here and see, because quite frankly, if you're bullish and the market goes against you, the ramifications are not nearly as dire as if you're bearish and the market goes against you. And I think to a certain extent, that's what we're seeing here, late 23 into 24.
Yeah, and listen, I get it. There's a good little chart that we have. I think it's from Bloomberg, just showing a bunch of the bullish strategists and where they are relative to the market. I mean, this chart is simple enough. You go back to the upper left here, and you see right where the all-time high was, about 4,800. We're about 4,720 or so. I think this chart was probably from last week. So here we are. We're up 24% on the year. The S&P 500 is at 4,740. Okay, so we're gonna make a new all-time all-time high before year end. All right. Like that's in the cards. And then the question is, what is discounted into that? And I would just want to kind of briefly kind of switch gears, Guy, from the S&P. You and I have spent some time thinking about, all right, what are the things that could cause, investors to start selling stocks again? 2 months ago, they were, didn't look so hot, right? And now it looks pretty great. And let's just pull up a 1-year chart of the Shanghai Composite. Okay, so we've been speaking all year long about the issues that they have with growth, whether they're going to stimulate or not. What are the sorts of things they're going to do to kind of backstop this economy? And we don't even need to get into the geopolitical stuff. I mean, look at that. Like that's what the composite's doing right now. Let's look at it on a 5-year basis. Okay. We can just kind of take a look at that. That just it looks sick. It looks really sick, right? Let's look at the FXI. That's the iShares, large cap Chinese ETF. And we've talked about this a lot of big internet names, a lot of banks and stuff like that, but make up a big weighting. And let's back that one out a little bit. Like, doesn't this have to be a thing for US investors that US investors are not pricing anything for? What does a meaningful slowdown in China look like? Because Fed Chair Powell told us last week, Guy, that they are, tweaked down GDP here in the US to 1.4%. A problem in China means that we are definitely in a recession, in my opinion.
No, look, I think you're right to bring it up. And if we could go sort of farther back and take a look, if you can take the FXI chart all the way back to the fall of 2008, you will see that low that we saw in October of 2022. I think it was 21.5. Remarkably, the same low that we saw way back in 2008. And that chart to me is something I think you really got to watch. There's no bounce here in the FXI. Yeah, we recently bounced, I think, north of 24 or so, but it's been under significant pressure. And if you go back in time and look at what happened to our equity market at the same time, obviously it wasn't particularly good. For whatever reason right now, Dan, and I think it's smart to point it out, our equity market seems to be completely not taking that into consideration. So I think one of the many reasons I'm concerned, and this is probably one of the top 5, is the continued weakness and unrest in China that I don't think our equity market is looking at all. And, you just go back and look at historically what's happened when the FXI has made lows. It sort of coincided with our equity market not doing particularly well. This time seemingly different. My point is, I don't think it is different.
Yeah, and I guess we made this point on many occasions. Like last year, at this time, the consensus was a recession, right? In the U.S., we had come off that low from October of 2022. We were rallying a little bit, but that felt like the sort of relief rally, Guy, that we saw a couple occasions, right, in 2022. And so consensus was really bared up. People were underinvested and the like here, and we went the other way. And I've also seen some data on years when you have EPS declines. The stock market usually does well in those years. So here we are now, we're the exact opposite, right? We're pricing in no recession. We're pricing in some rosy outlooks for S&P earnings, right? So the market's not discounting the potential for them to come in right now. And so to me, that sets up for a difficult 2024. But Guy, enough of you and I waxing poetically about this. Maybe our main man, our dear friend, Carter Braxton Worth of Worth Charting, can shed a little light on this. Yeah, look at him.
Stop for 1 second. I mean, that is palatial.
It's a good rig.
Look at the artwork. I mean, that's just a beautiful
Not
setting.
in the city, out of the city, enjoying a nice reprieve from comings and goings, but a lot of rain up here. Anyway,
No.
And then you've covered all the big subjects. I mean, consensus continues to be very bullish. Price targets are being raised. There is something about when you're within a fraction of a goal, just 2 push-ups more, you go for it, right? So, people want, whoever they are, want the new high. The real question will be, is there meaningful follow-through? Costco, for instance, got to its old high, broke out, and has continued. Not my bet. My bet was that it would falter. Does the market really continue, or does it eke out a slight new high and then falter? It's one of 2 scenarios, of course.
What do you think, Carter? So listen, obviously I've been off sides. It's interesting in 2022, not to go back and look at history, but what I'll tell you is I was bullish twice that year. It was in June of 2022 when the VIX traded up to 34. We said that was probably capitulation. The market could rally, 16, 17, 18%. That's what happened. And the same thing happened in October of that year, where the VIX again traded up to 34, 34.5, and we thought the market could rally. since then, 2023 has been a bit of a puzzle. What do you think has been missed by the likes of me? Just underestimating the amount of sort of money sloshing around and continued sort of euphoria around the market, because clearly it's something.
It just depends on where you start the storyline.
Yeah.
Let's consider this. So we were streaking higher all through the summer, right? We made that high on the 27th of July. At that point, you were getting the same thing you're seeing now. Strategists saying new highs coming right around the corner. But what happened was the exact opposite, right? Of course, Homebuilders dropped 20%, S&P dropped 12%, Apple dropped more than the S&P. And actually at the low in October, so we went down 3 months exactly, July 27 to October 27. Do you know on the October 27th low, the Dow was down for the year? Mm-hmm. So that it can change quickly. All of a sudden, it's not a good year. Dow Jones Industrial Average down, not a good year at all. But this ricochet has, of course, put everything back up on its feet. But some of the moves are excessive, right? Whether it's Uber up 60% or Homebuilders up 45% from just the October low, it does feel to me unsustainable. So the question is, does it just carry a little further and maybe makes the new high and falters? Or again, not my bet, does it go on and make important new highs and start to corroborate or confirm some of these very bullish views coming out of Wall Street?
Yeah. So Carter, quick question for you, because, that move in 10-year yields from 4% to 5% was quick, and the reversal was fairly quick too, right? So when I'm like listening to CNBC or looking at the Wall Street Journal today, and you're seeing headlines that, the 10-year is below, 4%, there's the graphic, there's the chart. Okay. It wasn't above there that much, right? So if we talk about long and variable lags, right, of the rate hikes that have existed in the Fed funds rate, right, and the 2-year and the 10-year Treasury, we're mapping it, but it never got as high, and there's always a spread there or whatever. Like, I guess my point is like the last time the 10-year U.S. Treasury yield was right here, you can go back and see it. It was in August, right? And the S&P was much lower. You know what I mean? So like, it's just kind of odd to me that now, obviously, the calculation is about what the Fed does to Fed funds. Okay, right? Like, so it brings it down. So is that a disconnect worth discussing here? Because the violence of the rally on the way back and the speed in which it got here, you know what I mean, is something that to me is pulled forward a lot of whatever comes next out of the Fed.
Yeah, I mean, it's so much always to do with not the current level of inflation, right, or 10-year yields or what have you, but the expectation that gets built in. And so obviously, when we were at 5, people were starting to buy into this higher for longer. And if you do start getting into the 6s or 7s, that does change the math, right? Essentially, for so many things, not only housing, but of course, really what sort of discount rate and multiple you assign to an earnings stream. But the truth is, we are basically, as you pointed, only to 5 briefly. Now we're at call it 4. These are numbers that really shouldn't matter. This is long-term money, right? We're not talking about 10-year money, whether it's 4% or 5%, shouldn't matter. And again, maybe just to repeat something that I think is worthwhile, I have a lot of clients saying that, look, it's all Goldilocks as long as it's for, 5 to 3.5. You start getting down into the low 3s, something is wrong. And so perhaps the market does believe this is Goldilocks, and therefore you're not getting any give back in equities. But it is not random that oil collapsed 95 to 65, rates collapsed, dollar collapsed, gold surge. And the only thing that has not sort of seen any fear, right, of course, is the general thrust in equities worldwide.
I'm glad you brought up crude oil, because we have a crude chart. These are our lines, not yours. I want to emphasize that. But, we are still seemingly, despite the bounce in this downtrend from effectively late summer, early September. Thoughts on this? Are our lines correct? They certainly appear to be. Yeah. And I mean, what is your thoughts here?
Well, it also just speaks to the vagaries. How does one explain intellectually? 68, July, 95, back to 68. A lot of oil, not enough oil, OPEC, no OPEC, inflation, deflation, China slowdown. Sometimes it's just about movement in price, money flow. But what we know now, as annotated by you, is that we have a counter trend of sorts, and the counter trend is getting awfully close to the downtrend line. So we're in a downtrend, clearly 95 to 68, and we've had a counter trend that probably doesn't last much more than where it is now.
Yeah.
I know Dan had some thoughts real quick, and I want to emphasize this. If you look at this downtrend, what sticks out to me like a sore thumb is each move to the trend line is basically to your point, has lasted a day or two. And that's illustrated in just the fact that there's consolidation at lower levels. Then you have the spikes that last a day, and then it goes right back down. I mean, seemingly that trend is intact. So I think what you're saying is this is effectively going to be a short-lived rally as well.
I am. Yeah, I would. I mean, put it this way. Again, it's always the trick is to suspend anything one knows or think they know. So if you live in Houston, you're in the oil business, you say, well, I know a lot about oil. Forget that. If it was just lines on a page, black background, white lines, and you didn't know whether there's a software company or a sushi maker or soda water or oil, what do we have? We have a sell-off that's substantial, and we have a counter trend that leaves this thing, we happen to know it's oil, but forget that, back at the downtrend line. So good technique would say sell unless and until it moves above the downtrend line, and then have the dexterity to perhaps flip it around and get long.
Yeah. And again, I love this chart because it just shows the level of enthusiasm we saw towards, crude oil and some of the dynamics that caused folks to buy it. And we remember that the XLE and the OIH, they looked about ready to make new 52-week and multi-year highs in some cases, right? This was just a few months ago. And I bring it back to the kind of brief discussion that we had about China. I mean, what is it saying about global demand? What is it saying about a global reflation trade? So to me, again, I think things get a lot more difficult as we get into 2024. But Carter, one group, and we've been talking about it a little bit, and I don't know if you heard us when we introed you. I mean, I got in front of the toll a couple of weeks ago in front of that earnings, and the way in which this stock rallied after a pretty benign reaction to its results and guidance, okay, but really to the rate move, is just astounding to me. And so I know you want to take a look at the home builders. I was a little early. I'm going to get back on the train here a little bit, but walk us through what you're seeing and why you think now is the time to feign home builders.
Well, it's a bonkers kind of move. We know the most rate sensitive things have moved the most, right? KRE up 20% in just a month, S&P up 4 or 5%. But the really biggest ricochet of all from the October 27th low is home builders, up some 40+%. And so the question is, so what? If it can go up 40, it means it was up 30, and now it's up 40, maybe it goes up 50. And it isn't about the percentage. It's really about the angle of the line. Unsustainable by all accounts. And my thinking is that if you have profits, book them, some of them, half of them, a quarter of them, or stay and write calls. But taking no measures whatsoever seems to be the wrong move, in my estimation.
Take a look if we can quickly, because I know Carter has charts. If on the fly we can pull up a Toll Brothers chart, because this is the one that's sort of, for a myriad of different reasons. They announced a stock buyback, but this little move north of 102 or something, Carter, reeks to me of sort of not capitulation, but maybe some euphoria. And you have this gap that we've made to the upside, a series of gaps since, again, I mean, we keep going back to that October 27th level. What does this say to you, if anything? Because I look at this and it scares the shit out of me.
Well, the first thing, right, is that if we weren't looking at a chart, which is depicting price action in a pictorial form, right, and we were just talking about this business, how does one explain intellectually that the Toll Brothers business was valued at X, $68 a share, and then just weeks later it's valued at 105? The truth is neither of those numbers are real. Valuation is a long-term thing. It's like Schiller, where you do a rolling multi-year PE and valuation, but it just shows the vagaries of trying to determine what something is worth this hour, this month, this quarter, this year, because as evidence right here, how do we explain a 20% drop from the July high to the October low, and now a 40, 50% advance just because rates have changed from 5 to 4? No. And it just is, sometimes you get overdone. This is overdone.
All right, let's take a look at the ITB. That's the ETF that tracks the home builders, Carter, because this one is pretty interesting. And I love, it's not just, we were just looking at one stock that is a component of it, but when you think about it relative to some of the major indices, I think that tells a slightly different story.
Yeah, so the ITB obviously is an ETF that mirrors housing. The XHB is another one, and we can look at the charts now. XHB has things like Williams-Sonoma in it. But what we'll see here is you'll see something that's sort of shot the moon. At least that's my estimation. From the October low, I don't know if we have the charts, but if not, we'll talk it through. You have an aggregate. This is one way to look at it. So we know the market's peak, 27 July, market's intermediate low, October. So the home builders sell off more than the market, twice the market on the way down. Let's look at the next. But what do they do on the way back up? They recover 3x the market on the way back up. Final iteration. So just start from the start to where we are now, Friday's close. The market is a slight bit above, but home builders are meaningfully above, right? You're having a 5x kind of thing. And so the question is, it's beta trade. We know regional banks have been like this. It's a rate sensitive trade, but it seems to me, just looking at those numbers, that it's too far, too fast. But let's look at the charts themselves and try to work at it that way. Just to put this in context, because the ITB doesn't go back as far as other aggregates. This is the Russell 3000 home construction index. So it's got everything in it, small and large, not to mention other related home building type stocks, whether it's Eagle, cement stocks, and so forth. Now let's put in the internal trend line. Okay. And one could say, so what? It's only 3 touch points, but it's a big move to a difficult level. If we include the 150-day moving average instead, just look at all other instances where we've been this far above the moving average. And typically it's a time to buy more? No, to sell. Let's drill down and now look at the ITB. Very similar. Of course, this is from the 09 low, from the absolute low of the financial crisis. And to my eye, it's just something. It doesn't mean it has to crash. Doesn't mean it couldn't eke out a slight more gain. But having it full long here doesn't make sense to me. And I would say with new money, I'd rather be short than long. If we go a little tighter in terms of time. Yeah.
No, please continue.
Oh, well, so here's a 5-year, 6-year chart. And look at this internal trend line here. We're right up against, and you might see it in the next iteration, we're well above the 150-day. You also, if we went maybe 2 slides back, you'll see that we're up against, sorry, I'm giving you bad instructions. Keep going. My bad. It's there. So you have the internal trend line from the 09 low, but if you look at the ITB, one more, you'll see the internal trend line on the 5-year chart. Anyway, moving on from that, there we go. Look at that. That's from the October low. You see the July high, the October low. You don't see an angle like that anywhere else on this chart because this is almost so steep it's going up and to the left. You're not allowed to do that. You got to go out to the right every day by one.
No, and I apologize for jumping you real quick before you go to the next one. I just want to go back real quick to the ones with the 150-day moving average because there's your trend line, obviously, this uptrend line that we're touching against. But what stands out to me more so than a lot of things, anytime you get to a standard deviation or 2 away from the moving average, which we're clearly at now to the upside, it mean reverts. And you can go back and look, Carter outlined it back in 2017, probably again on the downside in late 2019, early 2020, a couple times in 21 and 22. Every time we've sort of gotten away from it, we've backed and checked down to it or up to it. So Dan, this what sticks out to me. Carter, I know you have a couple more charts.
Yeah, I mean, just to Guy's point, I mean, it doesn't have to play out that way, but you look at the past instances, you're like, what, buy more? I mean, it just doesn't seem practical. Anyway, we might have a few more. Let's scroll down. This is also important. Now, how can this be? This is from the absolute financial crisis low. Bear Stearns, Lehman, everyone's done. Warren Buffett's bailing out Goldman Sachs. And home builders have tripled the performance of the S&P, which has Amazon in it, and Apple in it, and Microsoft. I mean, this is one could say, yeah, housing in America forever. But listen, I don't want that kind of angle, not in my portfolio. And just to put this in real context, look at this blue line. This is, forget the S&P, which has dogs in it like GM and Ford. The home builders have kept up with the QQQ. Which is to say that a highly cyclical business where you can lose money, it's based on leverage and lending and interest rates, have paced Microsoft, Apple, Google, Amazon, Meta. Wow. Anyway, 1 or 2 more charts. This is a ratio chart, a relative chart. This is simply taking the relative performance of home builders to the S&P. Look how steep that angle is. Again, from the final chart. Okay. And someone could say, wrong arrow, Carter. It's got to be a green arrow. It's going higher. All right. Well, that's what makes a market. My arrow, my thought is red.
Yeah.
15
Well,
years of data, Dan, by the way, suggest, again, just to go back to the mean reversion, that you will see that. And this is about as extended as we've been. I mean, the last time we were this extended was to the downside in the peak, sort of in the middle of COVID, obviously, and then you saw the recovery. This is the opposite, effectively, if you look at it, Dan.
Yep. Well, I think that's the best point to me as like a trader guy. Like that's where I was a little early a couple weeks ago with Toll, you know what I mean? And not, that focused on the potential for the sort of rate move that caused this surge in these stocks higher. I want to pull up my chart here really quickly. And this is just a 1 year of the ITB. And this is kind of how I think about charts. I obviously get Carter's fine work and I have the opportunity to go through all of his different iterations of it. I mean, the steepness of the line he's talking about, Guy, all those gaps that you kind of highlighted that we've seen, right, over the last month and a half or so. And I look at that breakout level at 99. That's what I want to play for a move back. It leads me to the options market. I'm going to take a look at the implied volatility versus the historical volatility, which is going to be lower in an ETF like the ITB, right, made up of a bunch of the components there. If you look at the green line, that's how much the ITB has been moving. So that's the 30-day at the money historical vol. The blue line below that is how much is the price of options, implied volatility. Essentially, it's below how much the underlying has been moving. That leads me to believe that maybe the options are a little cheap. So if I want to look to play via a directional long premium sort of setup and play for a move to fade this, okay, then I want to use options. I want to buy options. And this is how I like to play it. So let's look at the trade here today. When the ETF was trading 99.70, I could look at a put spread in February expiration. I want to give this a little time to play out. We know that the next couple weeks are probably going to be a little funny in the markets here, low vol and the like here. I think investors kind of get things resized up for risk taking as we get into the new year. So maybe things start to play out in January a little bit. But again, I'm looking at February expiration. I want to buy a put spread. I want to buy the February 99.87 put spread, paying about $3 for that, buying one of the February 99 puts at about $3.70, selling one of the way downside 87 puts at 70 cents. That cost me $3. That is my max risk. I break even down at $96 and I have up to $9 in gains between 96 and 87 bucks. I have losses up to $3 between 96 and 99 with a max loss of $3 above there. I like the risk reward here. Okay. I'm getting fairly near the money. It's less than a 4% break even to the downside. If the ETF is down 13% in the next 2 months on February expiration, I can make basically a 3-to-1 payout on the premium that I have at risk. I like that risk reward. This ETF, like Carter just said before, has rallied 15% in the last, few weeks or so. And so to me, I just think there's a really interesting opportunity to fade this using options, defining my risk. The last thing I'll just say, I like to use stops on trades like this. Long premium directional, 50% of the premium I spend. So if this trade is worth $1.50 at any point between now and February expiration, I want to cut the losses. The probability of me making money once I've lost 50% of the premium is not particularly great. And I don't want to see these sorts of trade ideas go to zero. That is a surefire way to lose a lot of money trading options.
I think to your point, you're making your time horizon is correct, understanding that the next couple weeks is probably not going to work meaningfully in your favor, but things can start to sort of get jump started, I would imagine, early in the new year, and that's when this thing kicks in. So the risk reward makes sense. You basically mitigated 23% of the cost of that put by selling the $87 put, and I think your levels are right, to be honest with you, given what we were just looking at in Carter's chart. So I like this trade the first time you did it. Didn't work out, but I like it again. Sometimes you got to get right back up to bat and get in again and see how it works out.
Well, that's the point. I mean, and Carter laid it out, with the charts, but if I liked it from a fundamental standpoint before the move, I kind of have to like it again. But what I've done here is move to something that has that less idiosyncratic risk, right? Of like one name kind of blowing out or outperforming one way or another. So that's it. All right, Carter Braxton Worth, we really appreciate you running through all of your fine work here. Thank you so much for being with us. We're going to get you back later on in the week. Can't wait.
Okay. Talk soon. Bye.
See you, bud. Thanks.
Looks good, Carter. I love that backdrop.
He's the man. He's the man. So Guy, 2 weeks left in the year. All right. Less than that in trading days, right? And we still got a lot of earnings. I mean,
Yeah.
this week we got FedEx, we got Micron, and we got Nike. I mean, all really kind of interesting setups. All about in 5% implied moves or so. Hey, and I want to, before we get to them, Adobe reported last week and they gave guidance that was, maybe the folks can pull up the Adobe chart for us. The guidance was a little light. I mean, there are some things to pick at. The stock's had a huge run. And it's interesting, they've had some kind of pushback. They tried to buy this company Figma for $20 billion. There's been a lot of regulatory concern about that buy. You see that gap from last week. It's kind of interesting. A lot of analysts, now that this deal has been called off, that was the headline of today, they say, well, they're probably gonna have $10 billion to add to their buyback. Fine. Okay. But the stock's only up a couple percent on that. Just curious thoughts here, because as we think about earnings for, this week and some of these big names, they've all had big runs. Every single one of those that we just mentioned here. If you are a C-level executive at these companies and you don't have great visibility, but your stock has done really well of late, you probably want to be like slightly cautious here, guy.
I would imagine, especially, I mean, think about the lack of clarity in 23. I can only imagine it's going to be worse in 24. So to your point, why would you start to forecast full year when there are just so many unknowns out there? So I'm with you. In terms of Adobe, I will say this is one of those stocks that you told me this the other day on Fast Money. It's one of those things that I've talked about for years.
Yep.
Stock typically runs into earnings. They usually report, they usually sell off, and then a week or two later, you're right back on the horse. We'll see if it plays out now. But the one that, Micron and FedEx to me are interesting. Just if we could pull up Micron first. Here's a company that historically has been extraordinarily cyclical. Obviously, the potential to be commoditized. You see the move we've had. It's been one of those things where there've been sell-offs. Each sell-off has been, have found buyers since July, basically, and I'm sort of spitballing here, higher lows, higher highs. We'll see if it's culminating now, but you got to keep your eye on Micron, which, as you said, got about a 5% in terms of implied move post earnings.
Yeah, no, it's interesting that this one's also interesting to me, Guy, because of some of the things that we've heard from some of the other semiconductors. So these guys obviously make memory and it goes into lots of different devices, but we've heard stuff over the last month or so during earnings that smartphones, PCs might have been bottoming, right? So there's some cautious optimism in those two end markets. So it'll be interesting to see what Micron has to say. And you can see that stock was really range bound, for the better part of this year, and the recent breakout has to do with maybe some of the peers and just kind of the excitement in and around some of, just the build out of data centers in and around AI and the like here. And memory goes into all that sort of stuff. Nike will be interesting to me, Guy, just to get a sense of like that higher end consumer discretionary. And then, FedEx, we talked about a little bit this morning. This is one where it feels like there's been no shortage of headwinds with FedEx. They had some labor issues. There are a whole host of things going on this year. But look at that, man. That is one heck of a breakout. I mean, I guess I just don't buy runaway breakouts like that. I'd love to see like that consolidation before it made that run to the prior highs. Like that's kind of the move that I probably would have rather played if I had a fundamental reason to do it, but not here.
If we could do a longer term chart of Federal Express, go back maybe 4 years or so, you'll see we were approaching the prior all-time high, which, if memory serves, I want to say was in the spring of 2021 or something. So that's a pretty good guess by me. So there you go. So yes, it appears as though in the prior chart that we're breaking out, but in context, if you think about where the broader market is, we're not there in terms of FedEx. So what I've thought for a while is FedEx can continue to sort of levitate into earnings. I think the scenario here is you continue, maybe you push up to $300 and then you fail. And then technicians will start to look at this sort of potential for a 2.5, 3 year double top, Nathan.
Yeah, I got you. And you know what? Like, I think timeframes are really important because you pull it out there and you say to yourself, okay, maybe we check back to that level where it just broke out from, and that would be a good consolidation level, making a move back towards those highs that you talked about, which are obviously above that $300 level. But again, that's kind of how we see the charts. Valuation is fine. This is their season right now. Like, they got to get it done.
Mm-hmm.
And then you got to see what sort of visibility they have coming out. So all very interesting. We'll be sure to update all of these earnings this week on the market call. We're going to have Carter back later on this week. So I think that's it, Guy, on a very, very special day, a very special episode of Market Call. I don't know if we've ever done one on Deck 18.
No, I appreciate that. Thanks, everybody. The warm wishes. Doug Cass points out that, the advanced declines over the last couple sessions have not been seemingly sort of fly in the face of the strength we've seen in the broader market. So we'll see at some point, does that kick in? But again, for you folks that have been bullish, congratulations. I mean, it doesn't matter the reasons why. If you're a long stock and it goes higher, the dollars you've earned are the same, whether you were right for the right reasons or wrong reasons. So there you go. But I will tell you, all the things that we're seeing, we talked about the FXI, the weakness there. There's so many things still to be concerned about. Nothing, in my opinion, nothing fundamentally has changed. We didn't even bring up the leading economic indicators that are now down 19 months in a row. And the fact that if we make it to February with this continued yield curve inversion, it will be historic in terms of duration. And I will tell you, if you go back and look, since there's been data, the longer the inversion, typically the worse the downturn. And I'm hard pressed to believe it's going to be different this time.
Yeah, I'm with you on that, Kim. And by the way, in my inbox, Guy, I have Doug's 10 surprises for 2024 from Real Money Pro. I love that. I've been reading it forever. I have not read it yet because it just hit my inbox. So go check that out, people. Doug has forgotten more about markets than I might ever know. So shout out to Doug. All right, Guy, we did it, bud. Go have a great day. You deserve it. I can't wait to get back together with you in person and celebrate. And hey, look, real quickly, here's a headline that's coming across the tape. Okay, sorry to meander here. This is the Nikola founder. Okay, so that was this this EV truck company. Remember this? So he just got 4 years in jail. Okay, for lying to investors about just kind of emission stuff or outlook for his things. Think about that. 4 years in jail, and this sap is going, for lying about EVs. Elon Musk has been lying essentially about his company for 10 years, and he's been rewarded as the richest man in the world. Pretty astounding split screen, don't you think?
Well, there you go. I mean, on
no
one
comment. You can say no comment.
No. I mean, on the one hand, I couldn't identify the Nikola CEO.
He was on our guy. He was on our show a couple.
No, but
times.
You understand my point. Yeah. One of these people is obviously one of the most famous people in the world. The other one you couldn't pick out of a lineup, and I think it's Trevor Milton, the guy, and he was on our show. So there you go.
Lying to us,
man.
Yeah, well, there you go. Have at it, people. All right, Guy Adami, take us out, man.
Been a great show. I want to thank Carter Worth, obviously FactSet Financial Data and Analytics, powered by Tomorrow. Tomorrow being Tuesday, a CME day. We'll be back with some futures trades, Dan Nathan.
All right, see ya. Thanks, everyone.